Hi, everybody. This is Chad White. I'm in Toms River, New Jersey, and I'm here with two friends of mine. The first person is that I'd like to introduce is Joe Elsasser. He is a financial advisor in Omaha, Nebraska, and Daniel Keever from Evergreen Marketing in Delaware. And I'd like to pass it off to Joe so he can introduce himself, uh, and and then we'll go from there.
Awesome. Thanks, Chad. Thanks for having me today. Joe Elsasser. Uh, as Chad mentioned, I've been in financial services for roughly 20 years. I'm out of Omaha, Nebraska. Chad and I have worked together for a few years now, so pretty excited to be here.
Again, Dan Keever. I have had the honor of leading the team that works with Chad on his marketing and client communications. We love working with Chad and Safe Harbor because one of their biggest passions is educating clients, and they brought in Evergreen to help do that through content. So excited to be a part of this conversation. I think this is one of the topics that clients need most, whether they realize it or not. So go ahead, Chad. Why don't you tee up what we're talking about on our call today?
So today we're going to talk about Social Security planning and tax planning and overall retirement planning. And I wanted to bring Joe on because Joe, about 10 years ago, maybe more, developed a software because he was sitting with clients and realized he didn't have the tools he needed in order to help his clients. And so he had to create them himself, which is a very heavy lift. It's a hard thing to do. And so I'm going to let Joe go into how he went about creating the first Social Security optimization software that came on the market for financial advisors. And Joe himself is an active financial advisor in Omaha, Nebraska. So go ahead,
Yeah.
Joe.
So when we were thinking about this problem, back in 2008, 2009, it's like, what are the major questions that our clients had as they entered retirement? And near the top of that list is Social Security. Then you think about it from the financial advisor's perspective, Chad or me or any other advisor you might work with. When you get down to it, there's only so much you can do from an investment perspective, right? The portfolio that you get from place A is going to be relatively similar. There will be differences, but they'll be relatively similar than the portfolio you get from place B. So what I was looking for was how can I add value to these core decisions that people have to make as they enter retirement, right? Social Security being the biggest one. It's irrevocable, effectively irrevocable. You get a year, but you've got that window between 62 and 70 to make that decision. And it's going to carry you for the rest of your life. And if you're married, if you're widowed, if you're divorced, you've got a lot more options than just claim early or claim late. Coordinating those decisions across multiple benefits can be a challenge. And at that time, there were even more Social Security provisions than there are today. So that's where we started, was by building out how do we identify all the options that are available, and then how do we narrow it down to the options that are expected to deliver the highest lifetime value to our client. I mean, at the end of the day, if we as advisors are able to deliver more value to clients, then we stand a lot better chance of growing our business.
Yeah, I was looking at the time that I met you, Joe, was I was looking for a differentiator. How do I differentiate myself from other advisors? Excuse me, I never liked having to compete. I always wanted to have an advantage. I wanted to have something that nobody else had. And when I came across your Social Security optimization software, I thought this is something that can really differentiate me because so many people, when we're thinking about Social Security, we're just thinking about, um, you know, the difference between if I claim early or if I claim later, and we call that a break even calculation. And so many people simply retire and then they automatically just turn on Social Security. We call that the default,
Yeah.
but they may not be taking into an account how does the Social Security affect their overall tax return and how does it affect withdrawals from retirement accounts? Can you talk a little bit about that?
Oh, yeah, because that was our next step. when you spend any time at all on Social Security, you notice how weird Social Security, I don't have a better word, it's weird, Social Security taxation is, right? If you've ever filled out a paper tax form, you get down to the Social Security benefits on the 1040 and you don't know what to put in there. You actually have to go into the instruction booklet and fill out a worksheet that incorporates your other income to determine how much of the Social Security benefit is taxable, which then goes back onto the 1040. And so if I have only Social Security benefits, I don't have to worry about paying federal income tax. But if I've got any other income, then I've got to go through that worksheet process. And those interactions, so as soon as we started diving deep into Social Security, it's like, wow, there are a lot of other similar interactions. The interaction between capital gains and IRA withdrawals, IRMAA premiums, if you've heard of the extra premium you get to pay if you happen to be successful for your Medicare. Net investment income tax. There are a variety of these distortions. And now with the new tax law, we've got phase outs of deductions that are happening that are creating even further distortions. So how can we look at an individual's tax situations or a couple's tax situation with kind of a landscape view to be able to say, okay, I can be comfortable that I'm going to fall just right into these brackets that everybody's used to, unless this happens or this happens or this happens. How can we get into that in a way that people can understand?
I'm excited for this as well, just as a side note. So living in the world of content with financial advisors, education is very hard when you're talking about talking someone through a complex topic. The whole reason people make mistakes is because they have a hard time wrapping their head around something like Social Security, which, Joe, to your point, there's nothing else like it as far as how you get it, how it's taxed. And it's kind of, you throw this variable that behaves totally differently into your retirement plan. There's a lot of room for mistakes, unforced errors, that I think a lot of it comes from people being talked at, which is what I love. The premise of this conversation today is how do we show versus how do we tell? And I think that this, if you're watching this and you're saying like, you know what, I've had this conversation, maybe with my investment advisor or someone else, but I've never walked away feeling like I understood the planning decision, the planning implications. I think I'll just give you a little sneak peek. I've looked at the slide deck. I think if you need the simplest answer and the clearest answer, this is going to be a really helpful conversation today that I'm very excited to get into. Do we want to move into that slide deck now, or is there anything else we want to hit on before we jump in?
I just want to say that one of the things I see people doing is they kind of have a mindset of, I'm going to retire and I'm going to do this. And a lot of our clients are what we call mass affluent. They have somewhere between $1 million and $3 million dollars in overall retirement savings. And they have a mindset of don't spend, save. And they're very frugal. And so when they retire, they look at it and say, well, I don't want to spend my own money. I don't want to spend the money that took me a lifetime to save up. I'm going to turn on my Social Security and spend the government's money, and I'm going to preserve my wealth and try to continue to make that account as big as I possibly can. And so we're going to talk about some of the traps that people fall into when it comes to required minimum distributions at either age 73 or age 75. But we're going to get into all that with the slides now. But what I wanted to say is try to have an open mind. Try not to just say, I'm going to do what Joe and I call the default. I'm going to retire and turn on Social Security and avoid spending up any of my own money, because that can cost you a lot in taxes, and it can also cause you to get a much lower Social Security benefit over the course of your retirement.
Yeah, and funny enough, we often find you can actually spend more by virtue. You can enjoy your wealth more by starting with the Social Security piece and then building the tax piece around it. Crazy.
Yeah, the investments and the whole retirement plan kind of come later. You know, there's no one software out there. I believe there's no one software out there that you can use for everything, where, you know, you need a separate software for Social Security. You need a separate software for tax planning. You need a separate software for retirement planning, and another software perhaps for your investment. And how are you going to invest your money in retirement? So it's very complex. and you need to know how to use all the different pieces and fit all the different pieces together so that it makes sense. But you can really add a lot of value by doing this for somebody.
Yeah.
We say our wealthiest clients, they're very intelligent people, and they're not going to become our clients if we're not adding value to the equation. So we've added a lot of value over the years.
Joe, why don't you take it away? Walk us through what we're looking at here.
Well, when we look at this is kind of a simple visual way to think about tax brackets, right? If you just go out and you Google tax brackets, it'll tell you that 0 to roughly $20,000 for a married couple filing jointly falls in a 0%. But you notice this chart doesn't start till over about $30,000, and then you get into the 10%. The reason for that is the standard deduction. Starting this year, we've got the additional senior deduction. So an additional $12,000 further that slides over to the right for a married couple who's both over 65. So you can see that as we add dollars, as we add ordinary income, as we move to the right across the bottom of the graph, only the dollars that fall in those ranges gets taxed that rate. And I think if you want to advance the slide here, so, that 0%, that's the 0%, that is the standard deduction. The 10%, only the dollars that fall in that range get taxed at that rate. Same thing with the 12 and the 22 and the 24 and so on. If we were thinking that we wanted to be really tax efficient in retirement and we had lower kind of overall income needs over our lifetime, then we would just fill up the 0% or the 12%. For the higher income people, we'd probably fill to the top of the 24%. And if that's all there was, the whole thing would be pretty simple, right? But what ends up happening in reality is you get these interactions between different income streams that really create a lot of, I'm going to say, confusion, but also opportunity for those in the know. And I know that's something that Chad and I have talked about so many times over the years, and especially every time there's a tax law change, because every year there's some little tweak. And then in some years, there's a bunch of big tweaks. And whenever those happen, we really need to be revisiting the overall strategy through the course of the retirement.
Chad, do you find that this is something a lot of your clients already understand by the time they're talking to you about retirement, or do they have kind of a different understanding of how their taxes fill up these brackets?
Some clients do, some clients don't. I actually have quite a few clients who do their own taxes, so they understand a little bit more than most. And one of the things is that's most important in retirement, I think maybe even more important than when you're working, is that in retirement, people are always concerned about their tax bracket, their tax bracket, their tax bracket. It's not so much the tax bracket, it's what's called your effective marginal tax rate. And that is the blend, the overall blend of all the tax brackets that you hit along the way. So when you average it out, you're averaging in that 0 up until 30,000. You're averaging in the portion of your income you pay 10% and 12% and maybe 22% on. And the effective tax rate is always lower than the top line tax bracket number. So when people ask, well, what tax bracket are you in? That's really not the important question in retirement. The important question is, what is your overall effective tax rate? Because that's the percentage of tax that you're going to pay on your overall income in retirement.
Yeah. And as important as that is, we also want to be thinking, all right, when you call as a client, you call and you say, hey, I need an extra $10,000. I want to do this cool thing. Our job is to say, well, where should we take that from? And so if the next $10,000, if we take it out of an IRA, oftentimes it's not going to fall into any of these. You're going to have interactions between different things. And you might, on that $10,000, even though your overall effective tax rate is considerably lower, that $10,000 can cost you a lot more than the bracket rate. We want to make sure we dodge those situations whenever we can.
Yeah, I was looking at one the other day, Joe, and it went from 22% to 45% on the next $1,000, let's say, that the client would take out of their IRA.
Yep.
And without having this tax map to look at, you would have no idea that it would jump from 22 to 45%.
So this one, we've got $90,000 of combined Social Security and $30,000 of net long-term capital gains. So this is a higher wage earning couple, and they're both 65 plus. So they're getting that new temporary additional senior deduction. But let's go to this next slide, because this is what their tax map looks like. The gray is what they actually pay. The red is the bracket rate, if you will. And keep in mind that the gray doesn't count Social Security benefits, because Social Security benefits, like we started the conversation with, by themselves, they're not taxable. They only can become taxable based on the other things we're doing. So for this couple, once they get to just under $10,000 of IRA withdrawals, they start paying an 18.5% effective marginal rate. That's on the next dollar they withdraw. And the reason is because a dollar of IRA brings in 85 cents of a Social Security dollar, and both get taxed at 10%. So that's how we get to 18.5. Now, a lot of people get really surprised by that 55.94 up there, right?
That's exactly what I was just referring to. That looks like the one I was reviewing with a client a couple of weeks ago.
That's
Absolutely.
the kind of thing where sometimes you look at these maps and your first instinct is, how on earth does that make sense? This is very unlinear, and it feels like there's tripwires baked into it. No one told me. And this is that you talk about, that interaction is unpredictable for a lot of people. Super helpful to see it.
Exactly. And if you like, we can go ahead and stack those up and say, how does that happen? Because you're right. It's not intuitive. It's unexpected. And the funny part is, if you had just taken the withdrawal and not paid any attention, by the time you do your tax return the next spring, it's higher than you expected. You got a surprise, but you're not really thinking about all the ways you could have avoided it, right? That's not how it works unless you're proactive. And that's the value. So let's walk through how that works.
Well, that's what planning is all about, being proactive, looking forward. One of the things we do with people a lot of times is, they might be 67, 68 now, and we look forward to when their RMDs, their required minimum distributions, are going to start. And we say, well, what tax rate are we going to be paying then based on today's laws? Now, things may change between now and then, but what would be the impact today? And if we see that it's a much higher tax bracket, then there may be some opportunity to try to mitigate some of that now.
Oh yeah.
And that's what planning is all about.
I would also just highlight too, one of the things that you guys know this from the number of conversations you've had with clients, is the Social Security question of when to turn it on. It's very hard to make that in a vacuum. Just about how long do I think I'll live, or do I want to spend the government's money instead of mine? But I also think people don't always realize the effects of the decision until these interactions start happening. Like RMDs is one that we talk about a lot, just in terms of like, well, now you have forced income coming out that you don't have as many options to drive your taxable income down. And if you have already turned on Social Security or a pension or other things like that, you start ending up with, like you said, the language of the default is very different than, okay, I have a thoughtful cause and effect understanding of what I should turn on when, where should I pull that extra $10,000 of income? Maybe I should have done Roth conversions 10 years ago, all those sort of conversations. But it is interesting how all of these things kick off around that first question of, when do I turn on Social Security? It's a much deeper rabbit hole than I think a lot of retirees realize.
Well, when I see somebody with a larger size retirement account and they just retired and they're 65 or 67, and the first thing they say to me is, well, yeah, we turned on our Social Security already. I just kind of cringe, because I know, they have $2.5, $3 million in IRAs. They're probably going to be hitting what we call the IRMAA thresholds when required minimum distributions start. And that will be for the rest of their life, because they didn't do some forward-looking planning earlier, and they maybe could have avoided some of that.
Yeah, and that's that needle spike on the map. That's the first IRMAA threshold for them, in case you were wondering.
People they come in and they don't even know what IRMAA is. I've had people come in with larger size accounts, and they say, what is this? And why am I paying it? My Social Security was $3,500 a month, and now it's $3,000 a month. Why is my Social Security $500 a month less? And my wife's is $500 a month less too. What's going on here? And they have no idea why it's happening.
Yeah.
That's the frustrating thing for retirees. It's very, very frustrating.
Yeah, especially because it kicks in 2 years later. It's
Yeah.
not like oops, I know why. It's 2 years later. Why the heck did that happen?
I had someone come in a couple of weeks ago with their CPA, and we sat down together with their CPA, and I was going over this with him. And the client is 63 years old. He has a $3.5 million IRA. So he was already this year past the second IRMAA threshold. And I said, we're to the CPA. I said, we're past the second IRMAA threshold. We may as well go right up to the third one and do a Roth conversion this year. Now, that is something that no tax software is going to tell you to do. But that's just the nuance of putting together the art of knowing taxes and knowing how to use new tax planning software to help the client, because he's probably going to be past the second IRMAA threshold for the rest of his retirement.
Mm-hmm. This is interesting, Joe. I think one of the things that you have here is a breakdown on the coming slides of this 55.94% chunk here, which I don't like the one that goes all up to 100%, but I appreciate how skinny it is. If we can look at the breakdown of this 55%, like this, speaking of, I'd rather spend the government's money. This feels like it backfired. Should we get into that breakdown here?
Potentially, yeah. Let's dig in. So what we would expect, our $1,000 IRA withdrawal, if we were just looking at our IRA withdrawals, would fall into a 12% bracket. 12% times $1,000, that's $120. But what actually happens is that $1,000, it does get taxed at 12%. Then it drags in 85 cents of a Social Security dollar, which causes $850 of taxable Social Security. Without the withdrawal, it would have come through tax-free. That also gets taxed at a 12% bracket. It's $102, which then pushes $1,850 of capital gains that would have come through in a 0% capital gains bracket up to the 15% capital gains bracket. It's an extra $277.50 of tax. So I'm going to pause there, because that could have happened even before the Big Beautiful Bill Act. That's been there for the last 10 years. And still, there are very few people that realize all those interactions can stack on each other. Now, that said, Big Beautiful Bill Act gives us a break on the front end. Then it takes it back on the back end if you have too much income. So that's how we get from 49.95 to the 55.94, is because $222 of additional senior deduction gets phased out, which then gives us another 26 and change. And that makes another $222 of capital gains taxable at 15% as well. So you add it all up, that $1,000 withdrawal costs you $559 and change. And the key is just knowing where these are, because there's no listing that is going to tell you, hey, I can look at the brackets and the instructions and I can say, I can go to here. Nope. It's all about the interactions that are on your specific incomes that are going to produce these odd outcomes.
Now, both of you guys have had experience in your own right helping clients visualize the tax consequences of certain decisions. I'm curious, just on a human level, what is the reaction that both of you see when, we'll start with Chad, to when people see charts like this, or they see, okay, wow, there's a giant 55% tax spike, or I took $1,000 out, I expect 12%, but it triggers all these other taxes. What are some of the reactions, maybe we'll start with Chad, that you see when clients see things like that for their own planning?
I would say the main reaction is frustration, because they just don't understand. They don't understand how it works and why it does that. So it's very frustrating. And the biggest frustrations, I think, come in not so much about the tax brackets or the effective tax rate, but the IRMAA taxes are really frustrating people because they don't understand how it's calculated. They don't understand how it works, and they don't understand how to mitigate it in any way.
Mm-hmm. How about you, Joe?
Yeah, frankly, this is in my own practice. This is 5 minutes of every annual review, right? It's you're here. We want to get you to here. This is why we want to avoid here.
Mm-hmm.
That, and it's 5 minutes.
Yeah.
It's a simple conversation, but it couldn't be simple if we didn't have some way of visualizing it. And I know there are a variety of different ways that advisors are able to do that.
Yep. And I think one of the biggest things that both of you guys have harped on is that there is a luxury called time in this, where if you are having these conversations early, maybe you're approaching retirement or very early in retirement, haven't made any large irreversible decisions, you have a lot more options. So to Chad's point, it's very frustrating if you see it after you've made some decisions and there's not as many options. But Chad, I know that you and I have talked a lot about some of the potential strategies, which of course it has to fit each individual person. But what are some of the things that you represent? Almost like, hey, you're about to retire in 2 years. Here are some of the things that you will experience or see if nothing changes. This is your tax map if nothing changes. What are some of the things that you help recommend to, at times where it fits, reposition them for more tax flexibility?
Well, it depends. It's different for, like you said, it's different for every client. We do a lot of planning around income when people first retire because there's a lot of mistakes that get made at that point. And so we don't want to just fall into the default, oh, I'm retired, I'm going to turn on Social Security. We want to put a plan in place ahead of time. And that's one of the nice things about tax planning is, we're very busy in October, November, December meeting with clients, and our clients have a very good understanding of what they're going to be paying this April 15th when they do their taxes because we did the planning ahead of time. But that initial year, 2 years, 5 years after you first retire, that's what we call the honeymoon phase, depending on when you retire. Now, I have some clients that have worked right up till age 70. And so then you miss out on, because you worked so long, you miss out on some planning opportunities because Social Security has to be turned on by age 70. So the government starts to make decisions for you, right? You have to turn on Social Security at age 70. If you're born before 1960, you have to start taking required minimum distributions at age 73. So that's a specific amount of money the government is going to tell you you have to take out of your retirement accounts and pay taxes on if you were born before 1960. After 1960, if you're born after 1960 at age 75, your required minimum distributions start. So the honeymoon phase is really when you get somebody who maybe retires a little early. They retire in their early 60s. And then you have that phase where you can kind of pick and choose the decisions rather than having the government make those decisions for you. You have a period of time, the retirement honeymoon phase, where you can say, okay, I'm going to leave Social Security off. I'm going to do Roth conversions. I'm going to do all these things. But after a certain point, those decisions get taken away from you. And so that's what I see mostly is the retirement honeymoon phase is a great time to plan.
It is also funny, speaking of the language of client education, one of the things when you talk about defaults clients think about is maybe they're about to retire, whether it's early or just in general. They have a unique window oftentimes where they're going from a peak earning year into the lowest tax bracket they've seen in 30 to 40 years, maybe. And I think the way most people that I talk to think about taxes, I want to get a low score this year, which is the lowest I've ever paid. And I'm going to drive it down as much as I can. And when I'm already winning, I want to win some more. And now as close as I can get to zero is a great tax outcome, which financial advisors either cringe, laugh, or both. I'll actually pass the mic to Joe here. Can you talk about, just in terms of in that window, maybe the retirement tax mistake that people, whether it's turning on Social Security or one of these other things, what do you see, and what are some of the things that you might recommend to someone in that situation?
Well, Chad hit the nail on the head earlier when he said it's all about over the lifetime. right?
Mhm.
If over the lifetime you're expecting to pay X amount, what we don't want to have is some years that are really high bracket years and other years that are really low bracket years, because that is really wasteful. Each additional dollar in a high bracket year, if you will, or a high effective marginal rate year, it gets taxed at that highest rate. Where if I can fill up some lower brackets, if you will, or pay lower effective marginal rates early in retirement, then I might want to front load those taxes to ultimately reduce my lifetime tax bill. And I
Mhm.
think that's the balancing act that really adds a lot of value by taking the long-term view and being really prudent today, uh, tends to be really effective over a lifetime.
Chad has shared a number of client case studies over the last couple months that we've been working together. And I think the way that I would encapsulate it is you never want to waste a low tax bracket year because the money's going to come out sometime, whether it's your life or in your estate to your kids, you're going to pay tax on it at some point. And so if you're saying, well, I can pay tax on that 10% tax bracket today, or I can pay tax on the 22 or 37 as things pile up and income stacks up and I have less flexibility. I think it is really helpful. There's never a rule of thumb that everybody should do the same thing, of course, but having a planning process that helps you visualize where you are on the tax map, where you will be if nothing changes, and what actions you can take today to proactively levelize and bring more of those years potentially into lower tax brackets. I would much rather pay a little bit more in a 12% bracket than save that for a 37%. And I think that is the enormous value of having someone walk you through the planning process. And I think these visuals are a huge, huge benefit to that. So we are reaching our wrap up point here. So as one last word, Chad, I'll pass the mic to you. Um, what does it look like for someone to reach out and begin the planning process? What should they be ready for? What does that feel like?
Well, they can go to our website, safeharborwm.com, and they can send me a message or they can give us a call. We set up an appointment with them. Our first appointment is always a complimentary appointment to see if we're a good fit to work with them. And then they come in and we see how and if we can help them. We're not for everybody, but we try to help as many people as we can. And we do retirement planning in a what we think is a very unique way.
Thanks so much for having me. Always a good time.